Okay, in this video, we're going to talk about the income statement and the statement of stockholder equity. So let's jump right into talking about the income statement. Essentially, what we want to observe from this is what's referred to as operating performance, right? Typically, we've looked at the bottom line, right? That's the net income of the company, after we've taken into consideration all of the expenses of a company. And of course, in annual reports, you get a series of these. Typically, it's 3 years that you see. However, I might also add that one of the particularly important parts of this is to be able to identify certain kinds of profit. And we'll talk about that as we go through this. As far as an investor, the net earnings of the company is not the most important number to understand. As a creditor, it's not the most important number for you to be concerned about at all. So we want to talk about this as we reflect. In another video, we'll actually go through and talk about analyzing profitability of companies. So again, this income statement is called a statement of earnings. It shows revenues, expenses, identifies this bottom line, the net income, and ultimately shows us a picture of how much of the profit belongs to each share of stock. Essentially, it talks about a company's ability to translate sales into profits. And although this statement certainly is true, I think as investors, as managers of companies, we want to ask another question. It's the same answer, but it's looked at from a slightly different point of view. I look at an income statement as an illustration of how management controls the expenses of operations. Right? Management is going to run the company. Obviously, there are sales. In the end, there's obviously something called profits. But what profit represents is the outcome, the output, if you will, of making financial decisions throughout the year for the company. Right? How much did we spend on inventory for these products? Is it greater or less than it's been in the past? Do we have equipment that might be not performing as efficiently as we would like it to perform? All of these are questions that we can ask inside the income statement. Typically, income statements are listed in what's referred to as a multi-step format. It looks at these 3 different categories, if you will. Gross profit tells us how well we control the expenses of production. Operating profit tells us how well do we control the expenses of running the company. Now, what comes below operating profit? You'll see that in the next slide. But the questions then are, the things that follow are interest expense, which are a financing question, not an operations question, and taxes, which of course, we have to pay. So again, this is a great format. It allows us to identify these different categories of operations, of running companies, so that we can make some decisions about performance. Regardless of the format, right? There are certain things that are identified separately, right? There are things that don't represent ordinary business, right? Discontinued operations, right? We're going to shut down a product line because we're not making any money there. So those operations, they won't show up in the future. So we want to take them out today so that moving forward, we can make comparisons moving forward. Likewise, with some extraordinary kinds of transactions, things that don't happen every day. We don't want to include them above in the statement because, again, we want to make comparisons moving forward. Here's a picture of an income statement. As you see, if we get down to the bottom here, right, here's net income from recurring operations, and here's this line item for extraordinary operations. There are things that happen that are unusual before we get to net income. So here's gross profit. You can see that the gross profit of the company changes, but also since sales are changing, our control, our number that we want to look at ultimately is going to change. We will see this in the next statement we look at, which talks about common size statements. So in this next slide, what we'll do is we'll talk about how we can look at some relationships, right? So a common size income statement, we talked about a common size balance sheet. This is a common size income statement. Essentially what we want to be able to do is look at how the company has changed over time, or also relative to competitors or the industry. But we want to look at the components, those decisions that are made inside the company and how they may have changed over time. So we want to express every income statement item as a percentage of net sales. Again, this may show us how the decisions are made in the company. And again, relative to sales, right, we want to understand the importance of the line items, right? How much of the overall net income, right, of the input from sales, how much of it goes to this particular line item? So as you look here, here's 100% sales. Gross profit for this company, if you go across the line, gross profit has been increasing over time. So what we see that on average, gross profit is around 40%, which then means cost of goods sold is around 60%, right? So 40 plus 60 equals 100%. What about operating income? Operating income has also been increasing. The average is about 9.82%. So if we're looking at how the company is being run, right? Operations, the actual expenses of production have been increasing, and the net increase in operating profit has also been increasing. So management is controlling expenses very well, and in fact, they are reducing the impact of expenses. The next line items we have to look at are things like interest expense and or interest income. You can see it's a relatively small portion of sales. Taxes, relatively small portion of the total sales that we have. Net income for the company, if you look across the line item, if we look at operating from recurring operations, they have been increasing, and certainly we've had increases in net income. We can also see what earnings per share have been over time. Relative to sales, earnings per share are about 0.05%. Not a tremendous amount, but remember, earnings per share are in dollar amounts per share, so it's going to be a relatively small number. We see here that the stock price as a percentage of sales is not quite 1-to-1. On average, it's about 0.96% or about 1% of sales, ultimately shows in the stock price. So if we're looking at these line items, again, let's think about it. Gross profit talks about how we control expenses of production. Are managers making good decisions about the production line? Do we have the right kinds of labor force? Do we have the right kinds of inventory, right? Are we producing products that we can sell and sell at a profit? For operating expenses, it's all the other expenses of running the company, right? The selling and administrative expenses, marketing expenses, research and development are included here. All of these things are part of what we refer to as being operating profit, right? How well does management control the expenses of running the company? Apart from other decisions that they make that have to do with financing and investing activities, right? So this really is a great number to make to compare managers of different companies within the same industry, because we're not taking into account the decisions about other financing arrangements, about other investing and investment types of contracts, etc. It gives us a way to make comparisons. Anything below that then takes into account another kind of a decision, right? Earnings before income taxes and the effective tax rate, right? If you take the income tax expense and divide it by earnings before taxes, that ultimately will tell you what the effective tax rate is of the corporation. Typically, we find this number is going to be less than, historically, less than 30-40%. However, with the new tax code, hopefully in the future, we'll see this number is actually being much lower. We already mentioned things like special items, special line items, discontinued operations, and extraordinary gains and losses. Again, these don't happen very often, so we want to pull them out to show them separate from the ongoing concern of the business. Net earnings is that bottom line that we talked about. It's really the number most people talk about. And it's not that it's a bad number. Certainly it is. It gives us some great information. But if you're thinking about analyzing the underlying operations of the company, it really is a number. I've heard it referred to as being, it's just a very muddy number, right? There's lots of things going on here, and you really don't get a real clear picture of what's going on inside the company. Earnings per share, obviously, we've talked about this several times before. This is all about how much of the profit belongs to the shareholders. Sometimes you'll see different ways that this is listed. You will see basic earnings per share, and you will see diluted earnings per share. The distinction is really based on the capital structure of the company. The slide here refers to something as being complex. If we have things like convertible securities or warranties that are tied to common stock, then the diluted earnings per share says, look, if every single contract that could be a stock was turned into a stock, what is the maximum number of shares of stock? And then that's the number they use to calculate earnings per share. There is also a line item, something called the comprehensive income. These are even for more items that are shown separate and distinct from the operations of the company. Again, the purpose of this is to, number one, identify what they are specifically, but also so that we can make comparisons moving forward. These things don't happen necessarily every year. So if we're involved in international transactions, there may be some currency issues we have to deal with. Pension liabilities. If there are unrealized gains and losses in sales or purchases of assets, then we may have to recognize. But again, the point here is that it separates them from the rest of the statement so that we can make comparisons. The final portion of this then is just the connection between this income statement and the balance sheet, right? We need to understand how they're connected. They are connected through retained earnings. So the stockholder equity section shows how the equity section, in particular dealing with things like retained earnings and shares, how those things have changed since the previous year. So we're going to include transactions here like the payment of stock dividends, right? Stock splits, reverse stock splits, cash dividends are going to be shown here. Any kind of repurchase of shares will be shown here. So in the end, what we want to do is illustrate in greater detail how the ownership piece of the company has changed. So we'll show these kinds of events that are listed here: repurchasing shares, the issuing of shares, cash dividend payments, I mentioned the repurchase. They'll all be shown here to represent how stockholder equity has changed since the previous year. Again, as an owner, this is something that you obviously have a great deal of interest in. Number one, you just want to be curious as to how your investment has changed. But it could change in such a way that now you are either more optimistic or less optimistic about this investment moving forward. So that's the video on the income statement.